This video introduces a superior, more transparent, cost-effective, and safer way to trade Bitcoin, long or short. Educates you on the contract we're trading, the 175-year-old exchange it's traded on that negates any concern in the value of the Bitcoin you're controlling or the safety of funds in your account. Explains margin requirements, how you can earn interest on them, and the collateral you can pledge to satisfy them. Shows you how this contract offers you the lowest carry cost on leveraged positions both long and short. Reviews why this contract is the most time-efficient and cost-effective way of shorting this market. Introduces this contract's liquid and underlying options market, enabling you to define risk on every trade and for the duration of every trading period using premium neutral strategies like collars. Explains how orders are executed honestly and clean with 100% transparency using defined, published, objective, and regulated rules for market, stop loss, and limit orders. Reviews transaction costs, both disclosed and more importantly, undisclosed. Shows you how your account balance is guaranteed plus or minus trading activity by an institution that's done it successfully for more than 175 years. Explains how, if you're a U.S. citizen that now has to report crypto gains, how trading this contract offers you by far the lowest tax rate on short-term gains. Introduces one of the many automated trading accounts, or ATAs. These programs are 100% objective, fully disclosed, provide all historical data, including every trade, enabling you to verify past performance and monitor trades forward as they occur. And finally, shows you how to trade an ATA automatically without wasting any time on cancel replacing orders, monitoring trades, or verifying trade execution using time and sales to ensure you're getting clean fills. Your only tasks when trading an ATA are choosing a market or multi-market allocation, the size you want to trade, your overall account risk, and turning the program on or off whenever you feel like it. The Bitcoin contracts and underlying options we're trading are on the Chicago Mercantile Exchange, the world's oldest and by far the largest dollar volume derivatives exchange on the planet. Face value of all contracts in all markets traded on the CME now exceeds $25 trillion per day. The Chicago Mercantile Exchange has always offered the most innovative contracts in the global marketplace. Very early in my career, I had the honor of working for and knowing the three-time chairman, Jack Sander, pictured here. Jack, along with Leo Melamed, were the founding fathers of financial futures. Before them, there were no liquid derivatives contracts in currencies, interest rates, or stock indices. And in 1992, because of their efforts at the CME, Globex came to life, the world's first 24-hour online platform for futures and futures options trading. Now the CME has done it again, creating a whole new sector of cryptocurrencies and cryptocurrency options to trade long and short, cost effectively and safely, nearly 24 hours a day. CME crypto contracts are not perpetual futures like the ones offered through crypto dealers like Coinbase. CME contracts are agreements to buy or sell an exact amount of crypto on or before an exact date in the future. You can trade in and out of these agreements, long or short, nearly 24 hours a day, as many times as you'd like, on or before the contract's delivery date. Bid-ask spreads are verifiably far tighter and far more consistent on CME contracts. Traders pay the exact amount of carry cost on long positions as they collect on their short positions. And there are zero leverage initiation or liquidation transaction fees. Out of the crypto contracts traded at the CME, the micro Bitcoin is one of the oldest and one of my favorites. The micro contract represents 1/10 of a Bitcoin. Each $1 move in the price of Bitcoin represents a 10-cent change in contract value. For example, if the price of Bitcoin changes from 110,000 to 145,000 or up 35,000, it represents a change in contract value of $3,500. So it's pretty hard to get in trouble trading a micro contract. It's not like crude oil, where you can have a $30,000 move in a few minutes. A big day in micro Bitcoin is $500. The margin requirement for 1/10 of a Bitcoin is $2,822. This is the amount of money you need to have in your account to initiate and maintain a Bitcoin position. To collateralize your margin requirement, you obviously can use cash. However, many member firms allow you to collateralize margin requirements using U.S. Treasury bills that you earn interest on. Corporate debt, foreign sovereign debt, gold, tips, selected stocks, exchange-traded funds, and a variety of other instruments. Let me give you an example of how this works. Let's assume you're long 40 micro Bitcoin contracts, anticipating the price of Bitcoin moving higher. 40 CME micro Bitcoin contracts is equivalent to 4 Bitcoins. In this example, the price of Bitcoin is $119,560. The total value of the position you're controlling, $478,240. Margin requirement per CME Bitcoin contract, $2,822. Total margin requirement for 40 contracts would be $112,880, which controls this 40 contract position worth $478,240. This $112,880 is the amount of money you need to have in your account to initiate and maintain this 40 contract position. If your balance falls below $112,880, your member firm has the right to reduce your position to be compliant with the required $2,822 per contract. Let's assume you're a responsible trader and you have $350,000 in your account. Of the $350,000, $300,000 can be in a U.S. Treasury bill, which would currently be earning you $12,960 in annual interest income, leaving a free-floating balance of $50,000. Even though your free-floating balance is only $50,000, this $112,880 margin requirement would not be at all problematic for any member firm's margin department. Because you have a $300,000 Treasury bill in your account, which a member firm's margin department values for collateralizing margin requirements the same as cash. As far as the member firm's margin department is concerned, you have $350,000 in cash, controlling a position worth $478,240 with a margin requirement of $112,880. I think you can see the benefit of being able to post Treasury bills to satisfy margin requirements. The one caveat: with most member firms, you have to tell them to purchase the Treasury. Most won't offer. If you don't tell them to purchase the Treasury, they legally can and do keep the interest on your balance. In the industry, it's referred to as the float. And many firms pay brokers a percentage of this float to provide brokers incentive not to offer Treasury bills to their customers. In this case, they'd be keeping this $12,960 when it could have and should have been paid to you. Now let's compare the cost of leverage on a CME contract versus the cash market. Because we're trading in agreements to buy or sell a specific amount of Bitcoin on or before a specific date in the future, there is no interest charge on leveraged amounts. However, there is a carry cost that's built into the forward pricing. Note, the greater the duration of the delivery date, the greater the premium built into the forward price. How you determine the annual carry on a CME crypto contract is by taking 2 delivery months 1 year apart In this example, I'm using the September 2025 versus the September 2026. Take the delivery date with the longest duration. In this example, September 2026, trading at $128,450. Then subtract the delivery with the shortest duration. In this example, September 2025, trading at $121,140, which equals an annual carry of $7,310, or 6.03%. Because we're trading on the CME, a completely independent centralized exchange with no conflicts of interest, all fees including but not limited to the carry cost you pay on long positions and the carry cost you are paid on short positions are fully disclosed. Neither the CME nor the brokerage firm you trade through can legally generate revenue on the carry cost that's built into the forward price. Let me give you an example. Now, please remember, you can trade in and out of these delivery months nearly 24 hours a day, as many times as you want, on or before the delivery date. On a long position, the verifiable carry cost you would pay on a micro Bitcoin contract, which represents 1/10 of a Bitcoin, with a long entry price of $128,450 for September 2026 delivery, using maximum leverage, would be $731 annually, and you would know this exact amount before you put the trade on. On a short position using maximum leverage, the verifiable carry that you would be paid on a short position with an entry price of $128,450 would be the exact same amount of $731. This $731 you'd collect in annual carry would be the same trading a CME futures contract with any brokerage firm on the planet. There is no legal way for any firm to change the CME's disclosed carry price or generate revenue from the disclosed carry on a CME futures contract. Using Coinbase's website, let's compare the CME's $731 in annual carry paid or collected on a CME futures contract versus the same position traded using a perpetual futures contract offered and traded through Coinbase. The potential carry cost with Coinbase on a perpetual futures contract is so obscene, I'm just going to read their carry cost disclosure verbatim, then do the math on the break-even. Suppose a trader, Lisa, opens a $10,000 long position in Bitcoin perpetual futures. With a positive funding rate of 0.03% applied every hour, daily funding payment with 24 funding periods in a day, the daily funding cost would be approximately 0.72% per day, or 0.03% in carry cost is deducted from the account every hour times 24 hours equals 0.72% per day. If Lisa holds this position for 1 week, her total funding costs amount to $504. Again, this is $504 in just 1 week on $10,000. This is a rate that would make a New York Mafia loan shark blush. Lisa's perpetual futures trade at Coinbase has absolutely nothing to do with the CME. This trade was cleared by Nodal Clear, which is owned by a privately held company in Germany. Nodal Clear was organized in 2015 to act as a counterparty on energy trades. It was licensed to clear perpetual futures contracts in the United States in 2020. Nodal Clear acts as a counterparty for every perpetual futures contract traded at Coinbase through a procedure called novation. Because Nodal Clear is a privately held company, they're not required to, nor do they disclose the fees they charge their clients. And it is legal for Nodal to pay Coinbase, who announced their partnership with Nodal in 2025, service fees. All of Coinbase's perpetual futures trades are cleared through Nodal. On all of these trades, customer carry cost, which they refer to as a funding rate, can exceed 100% annually on the position's value. Translated, if you're using 5-to-1 leverage, this could completely wipe out an account in 2.5 months if Bitcoin's price during the same 2.5 months remained unchanged. Why the big difference in carry costs between a CME futures contract and a perpetual futures contract traded at Coinbase? CME contracts are CME designated contract markets, traded on an independent, heavily regulated, centralized exchange. The CME is completely independent from any of the brokerage firms that trade through them. In this type of designated contract market, it's absolutely illegal for a brokerage firm to manipulate the forward price of any CME contract to generate revenue on carry. Perpetual futures contracts offered by and traded through company dealing desks like Coinbase, although ultimately regulated by the CFTC, Coinbase perpetual futures have entirely different and fewer regulations than a futures contract traded on an independent and heavily regulated exchange like the CME. On Coinbase perpetual futures, it is entirely legal for Coinbase to charge any carry rate they can get away with on long positions and pay whatever they can get away with on shorts. If you ran a family office and trading was your primary way to preserve and enhance family wealth, would you trade anything with anyone where your annual carry charges on leveraged long positions could exceed 100%? Or a CME contract where you're paying a nice, clean, verifiable $731 annually on a CME long position and collecting the exact same verifiable amount of $731 annually on a CME short position. Let's look at one more scenario where you're trading the CME micro contract long and short. Let's assume you're testing the waters with $7,500 sub account and you have your broker plug into one of the many 100% objective and fully automatic trading accounts, or ATAs, that are now available on cryptos. The majority of the successful crypto ATA programs I track always objectively trade with market momentum, up long or down short. They're fully automated, 100% objective. Emotions, fundamentals, or subjective decisions just don't come into play. Their only objective is to be on the right side of the market, up or down. If they're wrong, they reverse and get right. When volatility gets too nasty, they get out. Because these programs trade long and short, carry cost is not going to be an issue. Sure, you're paying carry on longs, but you're collecting carry on shorts. And there are zero additional leverage costs with CME contracts. There are no BS opening and closing leverage fees. Long positions are charged the exact same amount that short positions are paid. Over the last 5.5 years, all the net carry costs on the Bitcoin 918 ATA were more than covered by the T-bill interest income earned on the monies pledged to collateralize margin requirements. Now let's look at how orders are filled. The transaction costs, both disclosed and, more importantly, undisclosed. Let's start with the CME, where all transactions for all buyers and sellers are cleared through one heavily regulated central location. The CME group includes the Chicago Mercantile Exchange, founded in 1898, Chicago Board of Trade, founded in 1848, New York Mercantile Exchange, founded in 1882, Commodity Exchange New York, founded in 1933, and the Kansas City Board of Trade, founded in 1856. The combined face value of contracts traded through the CME Group exceeds $25 trillion a day. This is a list of CME member firms. They represent the largest and fiscally strongest financial institutions on the planet. To be a member of the Chicago Mercantile Exchange, you must meet their very strict moral and financial suitability requirements by passing intense background checks and providing audited financials by a CME-approved auditor. Once approved, you need to purchase millions of dollars in CME shares. As a member, You agree to scheduled and unscheduled audits by the CME's Compliance Department and the Commodity Futures Trading Commission, the U.S.'s federal regulatory agency, to ensure you're consistently compliant with both CME and FedCap requirements. On demand, you must provide an auditable trail of every contract traded, including time and sales. This ensures both buyers and sellers are getting the best possible price. All customer funds at every member firm are segregated. Member firms can only receive funds from and send funds back to the exact owner listed on the account. All customer funds at every CME member firm are protected by the Financial Safeguard System. The CME's Financial Safeguard System has guaranteed customer balances in any amount, be it $1,000 or several billion dollars, plus or minus trading activity for more than 175 years. Now, I want to emphasize these requirements only apply to firms on this list, and only accounts held directly at these firms enjoy the level of protection that working with one of these member firms provide. Trading on the CME, your bid-ask spreads will run you about 10, and this is for everyone at all firms. In other words, if you traded a CME Bitcoin contract with UBS, and at the exact same time place the same exact order with Deutsche Bank, you should get filled at the same price. What makes order execution transparent and clean is all buyers and sellers for all trades at all firms run through one completely independent and unbiased central location. Let me explain. On any exchange, you have customers that want to sell and those that want to buy. Every buy and sell order has to end up with a CME clearing firm. The CME clearing firms feed these orders into the CME clearing system. Generally, CME member firms and their clients cannot directly see resting orders for other member firms. But if you're on your game, you have access to this data on quantities and prices and individual order queue positions. Again, transparency. This data is available to every single client that trades on the CME. Knowing this, it can help you with doing time and sales to verify the cleanliness of your fill. You can also see which side of the market is heavy, which can prevent a financial hemorrhage or potentially make you money. Liquidity. The CME clearing system handles every CME Bitcoin order from every firm on this list. All the firms that have to trade through them, which include all non-clearing FCMs, all introducing brokers, all associated persons who ultimately represent every customer who is trading the CME Bitcoin contract. Liquidity is not an issue. CME price discovery is independent, transparent, and the CME does not mark trades. They charge a fully disclosed flat fee of $7.50 for a full-size Bitcoin contract and $1.15 per micro. When the bid and ask match up, there's a trade. Within milliseconds, the executed buys and sells are distributed by the CME to all member firms. Again, within milliseconds, the member firms distribute all executed orders directly into their client accounts. When you're trading futures and the underlying futures options on the CME, you can place any type of order, including but not limited to market orders with millisecond execution time, limits, stops, trailing stops, stop limits, stop with protection, nearly any type of one cancels the other or OCO order, bracket OCOs, multi-bracket OCOs, time and force, inter and intra-market spread orders using either market, stop, price, or limits. As a heavy trader, one of the biggest reasons I trade through an independent, centralized exchange is the way stop and price orders are executed. The CME publishes rules and guidelines on how any order is executed, which over the last 175 years have been defined and refined to protect the client. They're not perfect, but having published heavily enforced rules and guidelines for order execution by an independent exchange that acts as a mediator for all clients to clear trades minimizes the way clients can get screwed on their order execution. Let me give you a quick example by walking you through how stops and limits are executed on the CME. Let's say the market is trading at 120.035 ask with a 120.025 bid. You place the stop at 120.10. The CME guarantees that the only way this stop can be activated is if the true market, as set by an independent entity, the CME, has a trade at 120.10. This isn't the case with cash and perpetual futures crypto dealers, because unlike the CME, which is completely independent from all brokerage firms, crypto dealers in cash and perpetual futures contracts set the price on what they call their exchange. The harsh reality is their exchange is nothing more than the company's dealing desk, and every customer that trades through them is captive to the prices and spreads they set. On the CME, if the true market has a trade at 120.10, the stop is activated and it becomes a market order. Trading directly with a member firm that doesn't mark trades and advocates fully disclosed commission, not some sleazy discount firm that advertises zero commission, then marks up the trade, there is a pretty good shot in normal market conditions that your order will be filled at 120.10. If it's a sloppy market and sell stops cascade, you're probably looking at 120 even. And yes, it could be worse. Let's say the tangible value of Bitcoin comes into question, and many of the people that currently own it and have pushed it higher start aggressively liquidating. Add in traders like me. We're not only going to cover our long and wrong positions, but we're going to reverse to short and get right. By the time we get filled, the price could be at 115,000 or lower. But at least trading through the CME, I have the ability to make sure the trade execution was clean. If it wasn't within the published defined guidelines, I can use the CME rules in place and the available trade data to make it right. If you have an orderly market and the market trades at 120.10, then down to 120.005, then back up to 120.10, the worst price I'd expect to be filled on this 120.10 stop would be 120.005, or I'd be all over it with exchange time and sales, volume, trade times. If that didn't provide the answer, I'd check the market order book, which discloses when orders were submitted. Why would I be so adamant? Because after the stop was hit at 120.10, the true low for the market was 120.005. Then we had an uptick to 120.10. In this case scenario, trading on the CME, your worst case fill should be 120.005, even if the next trade was 120 even or lower. Now let's look at how a limit order is filled on the CME. Let's assume we're coming in long. The market's at 20 by 10. Our GTC sell pegs at 120.50. The market has one trade at 120.55. On the CME, your 120.50 limit will be filled because the 120.55 will show on CME time and sales, which is independent and fully transparent price action generated by the free market through an independent exchange set up to protect traders, not a company-run dealing desk that sets its own prices, spreads, with countless conflicts of interest. If the market goes straight up to 70 and you're working with an honest firm who aggressively is trying to maintain and earn more of your business, you may even get filled at a higher price than your limit. There is no law that says you can't be filled at a better price than your limit. It works both ways. Just as you can be filled at a worse price than your stop loss order, you can also be filled at a better price than your limit. I pay the traders who work for me a nominal fee to check exchange time and sales on every executed order, enabling them to instantly verify the cleanliness of my order execution. If there's an issue with execution price as defined by CME rules, They'll correct it, then report back to me with a transparent and easily verifiable confirmation. This enables me to direct my business and order flow to the clearing firms that give me the best fills. It may sound like overkill on a micro Bitcoin contract worth $11,357. But if you're trading 40 micro Bitcoin contracts worth $484,560, or multiple full-size CME Bitcoin contracts worth $567,850 per contract, it's absolutely essential to verify the cleanliness of your fill. Let me walk you through what it takes to trade a full-size Bitcoin contract on the CME. A full-size Bitcoin contract is 5 Bitcoins, or 50 times the size of a micro contract. At a Bitcoin price of $119,090, the 5 Bitcoin contract would have a value of $595,450. Let's review your margin requirement, your leverage liability, exchange, regulatory, and brokerage fees, and what the fully disclosed nominal service fees are per executed contract for the different levels of service that are available, and what these different levels of service provide you. The exchange margin requirement is $140,992. Now remember, this one is 50 times the size of the micro contract that has an exchange margin requirement of $2,832. On this trade, per contract, I'd allocate at least $300,000. For every $300,000, I'd instruct the clearing firm to buy a $250,000 4-week treasury bill, because margin departments look at short-term treasuries the same as cash. It would have zero impact on my ability to use the entire $300,000, including the $250,000 in treasuries, to collateralize up to $300,000 in margin requirements. This $250,000 treasury bill would currently earn me 4.35% annually, generating me $10,875 in annual interest income. Because we're trading CME futures contracts, in this example, an agreement to buy or sell 5 Bitcoin on or before an exact date in the future, there is no interest on the leveraged amount. All carry cost is transparent and built into the forward price. You pay this carry on long positions, which is currently running 6.03%, and you collect the exact same 6.03% on short positions. There is no subjective interpretation on what the exact carry cost is on a CME contract. Leverage has to be respected. On this $595,450 position, if Bitcoin's value vanished and its price dropped to zero, similar to what occurred during the Dutch tulip frenzy in the 1600s, one of the earliest recorded market frenzies and crashes in history. During this mania market, tulips with no fundamental justification skyrocketed in price, fueled entirely by unbridled emotion and greed, only to crash at a faster pace than their ascent. If Bitcoin pulled an encore performance, and you were naive enough not to reverse your position to short and go with it, or at the very least have a hedge in place like a premium neutral option collar, the $300,000 you allocated for this trade would be wiped out, and you'd owe your clearing firm $295,450. If you establish this $595,450 position, put up just the $140,992 minimum margin requirement, again with no stop reversal or hedge in place to define your risk, and Bitcoin's price immediately dropped to zero, you'd owe your clearing firm $454,458 on just this one full-size Bitcoin contract. If for any reason you couldn't make good on this $454,458 debit, your clearing firm would have to assume this $454,458 debit and report it in their cap audits or disclose it during an unscheduled audit. If the clearing firm couldn't make good on this $454,458 debit for any reason. For example, if they had thousands of traders with similar debit balances generated by the collapse in Bitcoin, which resulted in their insolvency, the CME would do what they've done for more than 175 years and assume all debit balances of the insolvent member firm, transfer all positions and remaining equity for every customer account from the insolvent member firm to another member firm in good standing, then restore every customer's balance plus or minus trading activity, bringing every account's liquidation value to where it should be, and normally do this within 48 hours. Yes, with some of the larger failures we've seen during the 21st century, it's taken longer. One example is Refco in 2005. At the time of their demise, they were the world's largest derivatives broker. They became insolvent because of a massive fraud, originally thought to be $430 million, but eventually turned out to be nearly $2 billion. This fraud was orchestrated by its CEO and chairman, Philip Bennett, who ultimately served 16 years in prison. Another was MF Global in 2011, caused by a cluster of events including fraud, but primarily from MF Global using excessive leverage in foreign sovereign debt trades, resulting in a shortfall in MF Global's customer account balances of $1.6 billion. The fallout from Refco's $2 billion and MF Global's $1.6 billion took the financial safeguard system several weeks to sort out. But every account at these firms, protected by the financial safeguard system, was eventually restored to its rightful liquidation balance. Accounts that were not protected by the financial safeguard system, or SIPC, which is capped at $500,000, at both Refco and MF Global, who had, for example, spot FX accounts, only received pennies on the dollar, and it took several years. We all hope these insolvencies will never occur, but they do. Ask yourself, isn't it better to have your account protected by an entity as strong as the financial safeguard system and never need this protection than need it and not have it? For me, it's comforting to know when I trade on the CME, not only are they the world's largest and most liquid derivatives exchange that ensures me clean prices set by the free market, not some company dealing desk, that if any member firm I trade through becomes insolvent for any reason, including fraud, my account balance is guaranteed plus or minus trading activity by the CME Financial Safeguard System, an entity that has repeatedly been tested and successfully protected customer account balances for more than 175 years. If you ran a family office, primary objectives, preservation and enhancement of family wealth, would you trade any meaningful amount of money with a firm like Coinbase? Regardless of how they try to spin their FDIC and other explanations on how they protect customer funds, if you do your homework, the harsh reality is if Coinbase as a company becomes insolvent for any reason, there is absolutely no guarantees on your funds or on the positions in your account for any amount. And in the event of their insolvency, any monies received from the bankruptcy proceedings could take years to collect. And when you did receive your pro rata share, it could be for pennies on the dollar. Or would you work with a CME member firm, where in the event the member firm that you were trading with became insolvent for any reason, including fraud, your positions would be transferred to another member firm in good standing, and your account balance restored to its correct liquidation value, normally within 48 hours. Daily Bitcoin volume on the CME is $4.133 billion, which is a very small fraction of the $25 trillion in face value that gets traded in all markets on the CME daily. But this volume is expanding. Over the last 12 months, it's increased by 180%. To put this $4.133 billion in daily volume into perspective, let's compare it to Coinbase. Coinbase represents itself as the largest crypto dealer in the United States. It's not an independent exchange like the CME. It's a company-run dealing desk that subjectively determines the bid-ask spread on a crypto and generates an undisclosed amount of revenue on the spread they set. Coinbase's current daily volume in Bitcoin stands at $2.33 billion a day, making the CME's $4.133 billion in Bitcoin daily dollar volume 177.38% of Coinbase's $2.33 billion in daily dollar volume. So ask yourself, where are you going to find better Bitcoin liquidity? Coinbase with $2.33 billion in daily dollar volume, or on the CME with $4.133 billion in daily Bitcoin dollar volume? This $4.133 billion equates to 6.8% of total daily global volume. To clear a full-size Bitcoin contract, in this example worth $595,450, let's start with exchange fees. The CME charges a fully disclosed $7.50 to clear a full-size Bitcoin contract. The CME does not mark trades. They don't dictate bid-ask spreads, the free market does. They don't generate any undisclosed revenue on bid-ask spreads or carry charges. This $7.50 is verifiably the only revenue generated and paid to the CME for clearing a full-size Bitcoin contract. And every member firm has to collect this $7.50 on every full-size Bitcoin contract traded in a non-member account and forward it to the CME. CME exchange fees vary by market and contract size, but they're the same at every firm. For example, if you traded a micro Bitcoin contract at UBS, the exchange fee per micro contract would be $1.15. If you traded the same micro Bitcoin contract with Deutsche Bank, it would be the same $1.15. There are no exceptions to this rule. All regulatory fees are fixed at 2 cents per contract, bringing the non-negotiable and verifiable cost for a member firm to clear the Bitcoin trade in this example to $7.52. With a clearing firm's cost at $7.52, or even on a micro with their cost at $1.17, I hope you can appreciate there is no such thing as an average fully disclosed commission, including all exchange and regulatory fees of 55 cents per executed futures contract in the real world. It's mathematically impossible for a firm to charge an average of 55 cents and stay in business. They'd have to slip in disclosed add-on fees, or keep the majority of the interest income generated on their customer account balances, which is common practice with discount firms and still legal, or slip in undisclosed price markups on EFP trades, which is still legal, or payment for order flow, which is legal, or disclose commission markups, which is legal. For honest CME clearing firms that fully disclose all fees, clearing rates range from $2.50 to $5.50 per contract with no volume stipulation. These firms generally allow their customers to post treasury bills or other exchange-approved collateral to satisfy their margin requirements, enabling their customers to earn a treasury rate or higher on the majority of the money in their account, regardless if the money is committed to margin requirements or not. In this example, this 4.35% in T-bill interest income is generating this client $10,875 annually. A realistic trade cost with fully disclosed fees, clean and verifiable trade execution, have the majority of your account balance earning you T-bill interest, regardless if it's used to collateralize margin requirements, and have your balance guaranteed plus or minus trading activity by the financial safeguard system is $10.02, which in this example equates to 0.001765% of the contract value. If you opt to have a capable professional assigned to your account, who's going to be familiar with you, your account, and your positions, that will either help you enter and monitor your trades or enter and monitor your trades for you, add at least $5 in per contract per executed order, bringing the total fixed cost to $15.02 per contract per executed order, or in this example, 0.002645% of contract value. If you want a hardcore team where everyone on the team has a minimum of 15 years professional trading experience, trading on multiple international exchanges, where every person on the team has worked on the floor of a major exchange or on a major dealing desk, that are armed with dedicated servers, multiple state-of-the-art platforms, who will place, monitor, and cancel replace all of your orders according to any specific criteria and guarantee that it's done correctly or take liability if it's not, I paid as high as $14.98 per contract per executed order, bringing the total fixed cost up to $25 per contract per executed order, or in this example, 0.004403% of contract value. I have absolutely no problem paying highly trained, very experienced, extremely professional brokers who consistently provide me exceptional service, a fully disclosed nominal fee per contract per trade. Here are the tools my brokers work with and the services they provide for $12.98 per contract per trade, bringing my total fixed cost up to $23 per contract per trade, or in this example, 0.004050% of contract value. The brokers that clear my trades all have a minimum of 19 years professional trading experience. All have worked on the floor of a major exchange or on a major international dealing desk. To accommodate the automated trading accounts or ATA programs I trade, they have to have Chart VPS, Delta Series dedicated server. All use a minimum of Delta Mark 1, most use Delta Mark 2. The Delta Series ensures consistent uptime and minimize latency. All have CQG integrated client with multiple add-ons which can be dependent on their sector specialty. The Chart VPS Delta Series dedicated server, CQG integrated client combination enables any workload in futures, stocks, Forex, and crypto 24/7 with unmatched speed and reliability. CQG integrated client with the right add-ons can handle multiple accounts that trade on multiple exchanges, that trade different allocations, different markets, different number of contracts per market, different contract sizes. Each individual account can use a different level of leverage. For example, I might want to be conservative and trade a $250,000 allocation with $300,000. Or I might want to be aggressive and trade the exact same allocation with $200,000. At the same time with different clearing firms. If I trade the same allocations at the same time with different clearing firms, it also enables me to objectively compare order execution prices. Each individual account can have its own risk tolerance level. A risk tolerance level is nothing more than a stop loss based on the liquidation value of an account as of the settlement on any day. For example, if the account currently has a liquidating value of $500,000, and I set the risk tolerance level at $375,000, if the liquidation value of the account on any settlement falls below $375,000, the risk tolerance level is hit. It works just like a stop loss order, but rather than being triggered by market price, a risk tolerance level is triggered by the settlement valuation of the account on any day. When a risk tolerance level is hit, all positions are liquidated in the account on or before the next settlement, or the brokerage team who I'm paying to monitor risk tolerance levels is liable for any all losses in the account from that settlement forward. And the brokers I work with can do this at the same time through multiple clearing firms. This really makes it easy to see what firms are consistently giving me the best trade execution. And here's one of the best features working with this setup and a capable order placement and monitoring team. If the program is 100% objective, like the automated trading accounts or ATAs I trade, CQG integrated client with the right add-ons and right tech staff can fully automate all order entries, all cancel replaces, all profit objectives. I trade 24 different trading models in just the VBO ATAs alone. When trading is permitted in that market and model, all orders for that market and model need to be cancel replaced every 24 hours. Some of the ATAs I'm trading in beta real time require cancel replaces to be done every 15 minutes. To do this error-free manually in 50 plus markets would be impossible. Bottom line, my only tasks when trading an automated trading account is to tell the order placement and monitoring team the allocation I want to trade, which takes about 2 minutes. Provide the 100% objective trading parameters for each model and market in the allocation if it's not already in their system. Time expended 10 minutes. Tell them what sub-account to use or have them set up a new sub-account. Set my overall risk tolerance level for the account and turn the allocation on or off. Maybe another 5 minutes? In less than 20 minutes, I'm good to go, trading any of the 1,000 plus ATA allocations, with my overall account risk defined in writing, and error-free order placement guaranteed. Versus on my own, I'd be spending countless hours, day and night, cancel replacing orders, double and triple checking all orders to make sure they're correct, then monitoring them 24/7. This might be fun for a couple of months, but not every day for several decades. But their service doesn't stop there. My order execution teams monitor the exchange's market by order data, which discloses the majority of all resting CME orders in every market by price, time, and number of contracts. If the price and size of resting orders could negatively impact my execution price on any of my resting orders, they'll notify me and offer several solutions to minimize or eliminate the potential impact. Once an order is executed, they'll automatically check exchange time and sales to ensure the order was filled within the exchange's defined and published guidelines, and confirm it was a clean fill using the CME's data mined finals. If there is an issue with trade execution, they'll notify the clearing firm, provide the supporting exchange data, and tell them to correct the execution price. If they fail to correct the execution price within a reasonable amount of time, they'll refer the execution issue to the exchange's Division of Market Regulation and Enforcement, along with all supporting exchange data. I hope you can appreciate how having a capable team with the right tools in place that knows you, your accounts, your positions, handles all of your order cancel replaces, ensures you clean order execution, monitors all your risk tolerance levels, and guarantees that everything is going to be done correctly or take liability if it's not, removes any emotion associated with trading and enables you to maintain absolute trading discipline. To have this peace of mind on every trade 24 hours a day, I have zero problems paying the order execution and monitoring team $12.98 per trade, especially when the contract I'm trading is worth $595,450. Implementing this procedure and paying the $12.98 per contract per executed order ensures there are no undisclosed fees and brings my total fixed cost, regardless of contract value, to a total of $23. Or in this example, a fully disclosed 0.003863% of position value. Considering the Bitcoin ATA programs I trade require an average of 19 order cancel replaces before one trade is executed and they get paid, I have no problem paying this team an all-in commission of $16.65 on a micro, which is less expensive because the exchange fee is $1.15 per contract versus the $7.50 on a full-size contract. This $16.65 per contract in this example is equivalent to 0.13981% of position value. If you trade anything long enough, you'll quickly determine fully disclosed and consistent bid-ask spreads, the quality and consistency of your order execution, and knowing the exact carry cost you'll pay on long positions and the exact carry cost you'll be paid on short positions will be your greatest concerns in controlling your costs when you're establishing, maintaining, or liquidating a position. Let me walk you through a CME Bitcoin trade, all the costs, and what it takes to break even on a trade, long or short. The typical bid-ask spread on a CME Bitcoin contract is 10 points, although obviously in volatile markets the spread could be wider. In this example, this 10-point spread equates to $50 a contract. With Bitcoin trading at $119,090, contract value $595,450. In a perfect world with ethical, honest, and transparent order execution, your total cost to enter this trade, including your bid-ask spread, full-service brokerage fees, all exchange and regulatory fees, would be $73, or 0.01226% of position value. To cover your total transaction cost of $73, you would need a move trading a full-size Bitcoin contract of 15 points, or a move on a long entry position from 119,090 to 119,105. This would cover all your fixed transaction costs and your bid-ask spread. The carry cost that's built into the forward price on a long position worth $595,450 using leverage in this example would be $98.37 per day. Less any interest income you were earning on treasury bills you had in your account pledged to collateralize your margin requirement. Before I give break-even examples on short positions, it's important to remember, because carry cost on a CME contract is built into the forward price, you collect the exact same carry on short positions as you're paying on longs. You have to remember, the CME is a heavily regulated centralized exchange. The CME is independent from any firm that trades through it. They do not participate in or generate any revenue from the carry cost. Their only goal for more than 175 years is to protect all who trade through the CME. On a short position, full-service brokerage, exchange, regulatory fees, and bid-ask spread are going to be the same $73, requiring the same 15-point move to break even. However, in this example, we're going short, so we'd be selling the contract at the 119,080 bid. In order for us to make money, we need to buy back this position at a lower price. In this example, we would need the price of Bitcoin to drop from 119,080 by 15 points to 119,065. On a short position, instead of paying this $98.36 per day in carry charges built into the forward price, we're short, betting the price lower, and we're collecting this $98.36 in carry built into the forward price, which is an absolute game changer versus the cash market. I hope you can appreciate how transparent CME pricing is. The fact that there is absolutely no subjective interpretation in carry charges, and they'll be the exact same at every firm that trades CME Bitcoin contracts. Plus, you're collecting the interest income on the treasury bills you own to collateralize your margin requirements for this short position. If Bitcoin stayed at the same price, between what you're collecting in short carry and what you're making in treasury bill interest income, you're netting $134.12 per day on this leveraged short position. To really appreciate how significant this is, do the math on your carry cost on the exact same short trade in a FINRA-regulated cash market. Another big plus for CME crypto contracts is access to a liquid, capital-efficient, and transparent underlying options market. In this example, I'm going to use the CME Micro Bitcoin contract. The CME Micro Bitcoin contract is 1/10 of a Bitcoin. Each $1 move in Bitcoin represents a 10-cent change in contract value. Options expiration can be any duration, from 1 day to 12 months or anything in between. Because the CME is an independent centralized exchange, there should be no price difference from one firm to another. CME option prices for every strike and duration are transparent and fully accessible to anyone trading or thinking about trading CME crypto futures and options. Let's say you're trading something as simple as a weekly 918 exponential moving average. I literally can walk you through this in a few minutes, and it's outperformed a buy and hold strategy in Bitcoin with a lot less pain. Using a monthly or weekly option strategy to hedge risk, it's done even better. I'm going to give you the rules. As the chart progresses with time, see if you can call the major turns in the market up and down, and appreciate the benefit of trading long and short. The green area chart is the weekly price for Bitcoin from August 2021 through July 2025. The red line is the 9-week exponential moving average. The blue line, the 18-week exponential moving average. It's really this simple. Red above blue, you get long or stay long. Red below blue, get short or stay short. That's it. In this example, we're using weekly price data, certainly modifying your position once a week. But a lot can happen in 1 week in Bitcoin. So you really need to use a cost-effective option hedge strategy to objectively define your risk and knock out the stress. Without it, if you're on the wrong side of Bitcoin trading multiple full-size contracts in a volatile week against you, it could be worse than a bad divorce and 5 kids in private college, and it can happen in a lot less time. Let's watch the 918 weekly work. On the 17th of January 2022, is the red EMA 9 cleanly below the blue EMA 18? Yes. If you had this position hedged with a premium neutral collar or something as simple as an outright purchase of a put option, you would have had your downside covered from 41,800. Without it, you'd be reversing your long position to short at 38,180. On the 6th of March 2023, is the red EMA 9 clearly above the blue EMA 18? Yes. Again, if you have this position hedged with a premium neutral collar or something as simple as an outright purchase of a call option, you would have had your upside covered from 23,000. Without it, you'd be reversing your short position to long at 27,000. Obviously, there's a little more to this, and the weekly 918 is not the best 918 time frame to trade. But I believe you can see how even the weekly 918 can objectively define or confirm the long-term trend in a market up or down. Now let's see what it would take to hedge this position up on a monthly basis and objectively define risk on every trade and for the duration of every trading period. Let's start with the cost of hedging a long position using an outright purchase of a 1-month put option. If you'd like to confirm premium prices or experiment with this strategy on your own, for current free futures and options quotes, with no information from you or registration required, see barchart.com. Search Micro Bitcoin, then open BA Bitcoin Micro. Open the link for the current contract month, in this example, September 2025. On the menu on your left, halfway down, open Option Prices. From left to right, using the first drop-down menu, set it for Monthly Options. Next, Delivery Month. In this example, I'm using September 2025. Next, widen up the quote page to plus or minus 50 strikes. This will give you an idea of some of the out-of-the-money option valuations. The easiest page to work with is side by side. Use the daily settlement prices. It'll give you clean and accurate valuations. Intraday may be off if there's no trades at that strike. Days to expiration and expiration date show here. In this example, I'm going to hedge a $108,775 long position in micro Bitcoin for a month. A micro contract is 1/10 of a Bitcoin, with Bitcoin trading at $108,775. The contract value would be $10,877.50. To hedge this position, I'm going to buy the $105,500 one-month put, which expires in 30 days, which is 3.01% out of the money. Entering this trade, I used a price order and paid $314 in premium. Over the next 30 days, the maximum risk on my $108,775 long position is the distance between my long entry at $108,775 and where my put engages at $105,500. If in the next 30 days, Bitcoin's price dropped to zero, my maximum loss on market action would be $327.50. My total time premium risk on this 30-day $105,500 put option is $314. My worst case total transaction cost over the next 30 days to initiate and liquidate this position, in other words, get me in and out of this trade, which includes worst case bid-ask spreads for both the futures and the option contract, all carry cost on the long futures position, all exchange and regulatory fees for both the future and the options contract, a full service brokerage commission, which would include having the order execution team place my order, once filled, check time and sales on the execution prices to ensure they were clean fills, and monitor this trade for the next 30 days would be a total of $75. Again, this covers everything to get me in and out of this defined risk trade. My total time premium and transaction cost risk is $389. My total market risk for my long entry at $108,775 to where my $105,500 put engages is $327.50. For a total risk on this trade, all in, over the next 30 days of $716.50. Because you're trading both the futures and put option on the CME, the margin requirement on this trade would be equivalent to the maximum risk on the trade of $716.50. This margin requirement will remain effective as long as both the futures and options contract remain simultaneously in place. Over the next 30 days, the upside potential on this trade is unlimited. Downside objectively defined to $716.50, even if Bitcoin's price dropped to zero. Which in my humble opinion is a possibility when the crypto market realizes cryptocurrencies have no tangible value. Bitcoin's value, for example, is entirely determined by supply and demand and collective belief. Although only 21 million Bitcoins can be mined, you could create another Bitcoin 2 with another 21 million coins, Bitcoin 3 with another 21 million coins, Bitcoin 4 with another 21 million. There is no theoretical limit to the total number of cryptocurrencies that can be created. You can't say this about a tangible asset like gold. If something has an infinite supply with a limited demand, what happens to the price? It eventually moves towards zero. In this example, I'm going to hedge a $108,775 short position in Bitcoin for 1 month. The value of this contract at $108,775 is $10,877.50. To make money on this short position, I need to buy it back at a lower price. To hedge this short position, I'm going to buy a 1 month, 112,000 call option, which is 2.96% out of the money. To buy this call option, I'm going to use a price order and pay $308 in time premium. Over the next 30 days, the maximum risk on this $108,775 short position is the distance between my short entry at $108,775 to where my $112,000 call engages. Over the next 30 days, if Bitcoin's price goes to $200,000, my maximum loss on this short trade for market action would be $322.50. My total time premium risk on this 30-day 112,000 call option is $308. My worst-case total transaction cost over the next 30 days to initiate and liquidate this position, in other words, get me in and out of this trade, which would include worst-case bid-ask spreads for both the futures and the options contract, all exchange and regulatory fees, full-service brokerage commission, which includes having the order execution team place my order, once filled, check time and sales for the cleanliness of the execution, and monitor this position for me for the next 30 days would be a worst-case scenario of $75. Again, this covers everything to get me in and out of this defined risk trade. My option time premium and transaction cost risk is a total of $383, plus my market action risk of $322.50, brings my total all-in risk on this trade for the next 30 days to $705.50. There are literally dozens of cost-effective ways to define risk on every trade and for the duration of every trading period using option strategies. Premium neutral collars is one of my favorite, but that's a video for another day. In this example, I'm going to walk you through one of the Bitcoin automated trading accounts, or ATAs I trade, out of over 50 Bitcoin ATAs I track. Then finish up this video with the tax benefits of trading CME futures contracts versus the cash or perpetual futures markets. The Micro Bitcoin 12 is just one of several hundred ATAs that are available in any liquid market. Any broker with Chart VPS and CQG integrated client with the right add-ons can plug any properly capitalized account into the growing number of CME member firms that accommodate ATAs. When you're trading an ATA, your only responsibilities are deciding the ATA or combination of ATAs you want to trade, which markets or sectors you want to trade, for example, stock indices, metals, energy, or currencies, what contract sizes, and the number of contracts you want to trade. Then defining your overall account risk, referred to in the industry as a risk tolerance level. Finally, telling the order execution and monitoring team to turn it on or off by market traded or the entire allocation. Everything is fully automated, right down to the overall risk on the account. When you're trading an ATA, you're not giving the order execution and monitoring team full discretion. You're authorizing a specific strategy in specific markets, trading specific contract sizes and number of contracts, with overall account risk defined before the first trade goes on. This requires the execution and monitoring team to fully disclose any ATAs traded on behalf of the client. Strategy must be 100% objective and fully disclosed. They must provide all supporting historical data, all calculations and every trade entry and offset, enabling any client who wants to trade an ATA to verify past performance and determine if the risk in trading the ATA is suitable for them and their portfolio. They should have an ATA page. In this example, I'm opening the link for Micro Bitcoin 12. A downloadable text file opens with full disclosure of trading strategy, every open, high, low, close, all calculations, every order generated for all 1,634 trading days, every trade entry and offset, trade by trade cumulative net profit, current and maximum drawdown. In the case of Micro Bitcoin 12, how to calculate volatility and the pivot point are disclosed at the top. The number of data days used for calculations, volatility percentages, volatility and slope filters, worst case trail stop in the event a volatility calculated stop or stop reversal exceeds acceptable risk levels are disclosed at the bottom. The Micro Bitcoin 12 is a simple and durable program that's held together and done a great job for the last 1,634 trading days. I literally can walk you through how it trades, enabling you to verify past performance and trade it forward in less than 10 minutes. It doesn't have an opinion. It's momentum-based, 100% objective, fully automated, very simple, and follows the cardinal rules of trading. If the market's moving higher, stay long or get long. If the market's moving lower, stay short or get short. If volatility gets too high, in this example is qualified by the average of the last 5 daily ranges, rather than reverse into the momentum, you stop out to neutral. After all, wouldn't you rather be out of a market wishing you were in than in a nasty, volatile whipsaw market wishing you were out? Let me walk you through just how easy it is to generate the daily orders for this program, using the parameters disclosed at the bottom and the top of the downloadable trade file. I'm going to drop in the parameters from the bottom of the page, enabling me to quickly reference them as I walk you through this example. The Micro Bitcoin 12 uses the previous 5 24-hour trading sessions to generate the orders for the current trading session. In this example, I'm using the 3rd of January, 2019 through the 9th of January, 2019. To generate the orders for the 10th of January, 2019. To calculate the volatility we're using for order generation, you take the average of the ranges over the last 5 trading sessions. In this example, we're using the 3rd of January through the 9th of January, 2019. The average of the daily ranges from the 3rd through the 9th was 76. Next is qualifying volatility. In this example, to permit trading, the daily ranges over the previous 5 days has to be below the high filter. If the average of the daily ranges over the last 5 days is above the high filter, from neutral, no new positions are permitted. If you have an existing position, rather than reverse with momentum, you would stop out. This filter objectively adjusts with contract valuation. The average of the daily ranges between the 3rd and the 9th is below the high filter, and trading is permitted on the 10th. To generate the orders for the 10th, I'm going to take the average of the daily ranges between the 3rd and the 9th and multiply it by the K1. For the Micro Bitcoin 12, the K1 is 1.50. This never changes. It's used every day for the life of the program. Volatility multiplied by the K1 gives us a value of 114 for the 10th. To generate the buy stop for the trading day, in this example on the 10th, you take the CME opening on the 10th of 3,924, add the volatility multiplied by the K1. On the 10th, it came in at 114, and the total equals the buy stop for the 10th of 4,038. To generate the sell stop on the 10th, you take the open on the 10th of 39.24, subtract the volatility multiplied by the K1 of 114, and you've generated your sell stop on the 10th of 3,810. With the market opening at 3,924, what you've done is boxed it in. What you're banking on is the market will establish strong up or down momentum from the open, stop you into a position, and the market will continue moving in the same direction long enough to get you out with a profit. From the open of 3,924, if the market establishes strong enough upward momentum to hit your buy stop, there's a higher probability that the market will continue to move higher, then stall and reverse down. If the market did stall and reverse lower, your resting sell at 3,810 would act as your protective stop. If hit, this would take you out of the market and you'd remain neutral for the remainder of that session. To get put into a short position, if you're coming in on the 10th neutral and the market opens at 39.24, if the market established strong enough downward momentum to hit the sell stop entry at 38.10, there's a higher probability that this downward momentum will continue versus stall and reverse higher. If the market did stall and reverse higher, your resting buy stop at 40.38 would act as your protective stop for that session. If hit, this would take you out of the market and you would remain neutral for the remainder of that session. On the 10th, the high for the day was 4,046, which stopped the micro Bitcoin into a long position at 40.38. The resting sell stop at 3,810 automatically acted as the protective stop for the remainder of that session. The low for the CME Bitcoin contract on the 10th was 39.17. The 38.10 sell stop was not hit, which left the program long at 4,038 going into the trading session on the 11th. On the 11th, volatility came in at 92, below the high filter, which would permit sell reversals. To reverse the position, we would place an order to sell 2 contracts at 3,883. If hit, the first contract would offset the 4,038 long. The second contract would create a net new short. If we did get reversed into a short position at 3,883, the 41.59 buy stop would automatically be activated and act as the protective stop for the remainder of that trading session. On the 14th, volatility came in at 76, permitting new positions. The sell reversal was 3,908. The low for the day, 4,015. The sell reversal was not hit, leaving the program long at 4,038 going into the 15th. On the 15th, volatility came in at 88, permitting new positions. The sell reversal was 39.47. The low of the day, 40.62. The sell stop reversal was not hit, leaving the program long at 40.38 going into the 16th. On the 16th, volatility came in at 81, permitting new positions. The sell reversal was 40.09. The low, 41.30. The sell stop reversal was not hit, leaving the program long at 40.38 going into the 17th. On the 17th, volatility came in at 243, permitting new positions. The sell stop reversal was 44.39. The low, 47.86. The sell stop reversal was not hit, leaving the program long at 40.38 going into the 18th. On the 18th, volatility was 321, permitting trading. The sell reversal, 48.16. The low of the day, 47.97, reversing our 40.38 long to short at 48.16. To reverse this position, we've sold 2 contracts at 48.16. The first 48.16 sell offsets the 40.38 long, generating a net profit on the trade after all bid-ask spreads, exchange, regulatory, and full-service brokerage fees of $52.80. You have to remember this contract isn't small, it's tiny. Each $1 move is worth only 10 cents. Contract value at $4,038, $403.80. And on this tiny contract worth $403.80, on this trade we netted, after all costs, $52.80. Since this is the first trade, the cumulative profit is the same, $52.80. Drawdown from the previous high, 0. The second contract we sold at 48.16 created the net new short position. The Bitcoin 12 follows the same objective procedure every 24 hours. All cancel replaces are done automatically by the order execution and monitoring teams I work with, who guarantee me it'll be error-free or take liability if it's not. Again, it may sound like overkill on a tiny micro Bitcoin contract, but it's essential if you're trading multiple full-size Bitcoin contracts with each individual contract currently worth nearly $600,000. Let's watch the Bitcoin 12 ATA work marked to the market daily from 2020 through 2025 and compare its performance to a buy and hold strategy in Bitcoin during the same period. The gold area chart represents the value of 1/10 of a Bitcoin, which is equivalent to 1 CME micro Bitcoin contract. The date and dollar valuation of 1/10 of a Bitcoin shows in the top section in the left margin. The black line represents net gain owning 1/10 of a Bitcoin from 2020 through 2025. The daily mark-to-the-market cumulative dollar gain holding 1/10 of a Bitcoin shows in the bottom section in the left margin. The mark-to-the-market daily distance from the previous high holding 1/10 of a Bitcoin is represented by the light red area chart. The second section from the bottom in the left margin shows the dollar distance marked to the market daily from the previous equity high and maximum dollar drawdown as of that date using a buy and hold strategy for 1/10 of a Bitcoin. The green area chart represents the cumulative profit net of all bid-ask spreads, carry costs, exchange regulatory fees, and a full-service brokerage commission, trading 1 CME micro Bitcoin contract using the Bitcoin 12 ATA. The second section on the left shows the mark-to-market daily cumulative dollar net performance, trading 1 CME micro Bitcoin contract using the Bitcoin 12 ATA. The dark red area chart shows the mark-to-market daily distance from the previous equity high, trading 1 CME micro Bitcoin contract using the Bitcoin 12 ATA. The third section down gives the mark-to-market daily dollar distance from the previous equity high and the maximum dollar amount drawdown as of that date, trading 1 micro CME Bitcoin contract using the Bitcoin 12 ATA. On the 2nd of January 2020, 1/10 of a Bitcoin had a value of $911.70. To review the performance summaries for both Bitcoin and the Bitcoin 12 ATA on any trading day through the 16th of July 2025, pause this video. By the 8th of March 2021, 1/10 of a Bitcoin had a value of $5,058.60. Using a long-term buy and hold strategy, your unrealized gain on 1/10 of a Bitcoin would have been $4,146.90. Your maximum drawdown using a buy and hold strategy would have been $1,282.30. Trading 1/10 of a Bitcoin using the Bitcoin 12 ATA, your cumulative profit net of all transaction costs would have come in slightly less at $3,678.80. Maximum drawdown, trading the micro Bitcoin 12 through the 8th of March 2021, $1,214. Both had great performance. However, look at this move. It's nearly straight up. You wouldn't have had to be Warren Buffett to capture this. To give you an appreciation of trading both long and short, let's look at the performance numbers for these two strategies after a significant correction in price. 6 December 2022, 1/10 of a Bitcoin had a value of $1,666.10. Using a buy and hold strategy, your unrealized gain would have been $754.40. Buy and hold maximum drawdown, $5,211.20. Trading 1/10 of a Bitcoin on the CME using the Bitcoin 12 ATA, your cumulative net profit during the same period, net of all costs, $11,449.70. Maximum highest high to lowest low drawdown marked to the market daily, trading the Bitcoin 12, $1,214, net of all fees. Now that you've reviewed a 100% objective, fully disclosed strategy that position trades both long and short, as an investor, what sounds better? The long-term buy and hold strategy where in this example, your unrealized gain after nearly 2 years was only $754.40, with a drawdown of $5,211.20, or probably taking less time to tell your broker to plug you into a fully disclosed, fully automated ATA like the Bitcoin 12 that we've just reviewed, that automatically position trades both long and short, with overall account risk defined before the first trade goes on, and have a cumulative net profit during the same period because you're trading both long and short of $11,499.70. With a maximum highest high to lowest low marked to the market daily net drawdown of $1,214. All ATAs are 100% objective. All are fully disclosed, enabling you to verify past performance and monitor trades forward. All are fully automated. On your end, when you trade an ATA, daily order cancel replacement and position monitoring are a thing of the past. Order placement and monitoring teams take care of everything and guarantee you it'll be done error-free. All you have to do is to instruct the order placement and monitoring team to turn the ATA on or off whenever you want. It's as easy as initiating or liquidating one position. On the 16th of July 2025, 1/10 of a Bitcoin had a value of $11,963. The micro Bitcoin buy and hold strategy during the 5.5 years in this example had an unrealized gain of $11,051.30, with a maximum highest high to lowest low marked to the market daily drawdown of $5,211.20. The Bitcoin 12 ATA that we reviewed in this video, trading the same 1/10 of a Bitcoin on the CME, had a cumulative profit, net of all costs, of $19,947.60, with a maximum drawdown measured from highest high to lowest low marked to the market daily of $1,952.30. And the micro Bitcoin 12 isn't even the top performer out of the 50 micro Bitcoin ATAs I track. It's ranked number 11 out of 50. But it is one of the easiest to generate the daily numbers for, enabling you to verify past performance and monitor trades forward. One of the best things I like about trading ATAs, if an ATA stops producing, or it hits its defined risk tolerance level, There are 49 other micro Bitcoin ATAs that with one phone call or an email can replace it. Every day on our website and our new page on X, we post current positions, stops, stop reversals, and objectives. This page enables you to track trades in all 24 active VBO ATAs as they occur. Using the Micro Bitcoin 12 as my example, performance dates for this ATA show at the top, along with the market and model number, the last trading day and settlement price, volatility calculations for the current trading session, the volatility filters for that model, and if they permit new positions for the trading session, current position, unrealized profit or loss through the most recent settlement. In this example, we're long at 117,492. For this session, volatility filters permit new positions. Our sell stop for the trading session is 107,479. If hit, we would reverse the current long position to short by selling 2 contracts. The first offsets our current long position. The second creates a net new short. If the sell reversal is hit, the 115,910 buy stop would automatically activate and act as a protective stop for the remainder of that trading session. Cumulative net profit life of program shows at the bottom. In this example, I'd like to point out we're using a micro Bitcoin contract. This contract is beyond tiny. The average contract value between 2019 and 2025 was $4,092. Average margin requirement, less than $1,000 per contract. This section also provides the model's current distance from the previous equity high and life of program maximum drawdown, measured from highest high to lowest low, marked to the market daily. On the VBO ATA disclosure page, each of the 24 active models has a link for a downloadable text file, which includes full disclosure of trading methodology, all supporting historical data, all volatility calculations, every order generated for every trading session, every trade entry and offset, every trade's net profit or loss, trade by trade cumulative net profit and drawdown. On site and on X, you'll find monthly and annual performance trading all 24 active VBO ATAs through the most recent settlement. We've also linked the top 50 allocations of the 24 active VBO ATAs and how to create your own allocation trading any combination of these ATAs. One of the features I appreciate the most about automated trading accounts or ATAs is once you've qualified performance, defined your overall account risk, authorize the order execution and monitoring team to begin trading, that they run themselves. All I have to do is check my liquidation value whenever I want. This structure has enabled me to segregate myself from the emotion of trading, maintain absolute trading discipline, and have a life other than staring at multiple quote terminals and platforms for endless hours daily. Once you've made money, you have to worry about taxes. If you live in the United States, your IRS treats gains on CME futures trades infinitely better than gains on trading in the cash or perpetual futures markets. According to your IRS, the CME is a qualified futures board or exchange, and gains fall under the 1256 tax rule. Crypto dealers like Coinbase that facilitate trades in the cash market, or what they refer to as perpetual futures contracts, are not recognized as qualified futures boards or exchanges. They may refer to themselves as exchanges, but your IRS qualifies them as a cash dealing desk, and all crypto trades through them are taxed at a much higher rate than crypto trades on the CME. Adding insult to injury, your tax reporting for these transactions can be an absolute nightmare. Let me give you an example of how CME crypto trades are taxed under the 1256 tax rule. Crypto trades on the CME, regardless of trade duration, be it 1 minute or 18 months, are calculated on your net profit or loss based on the liquidation value of your account on the 31st of December. 60% of your gains are taxed at whatever your applicable long-term tax rate is, 40% at your short-term rate, again regardless of trade duration. If you're subjected to U.S. taxation, every year you fill out a one-page form called a 6781. And this one page covers all your futures accounts at all firms. You do not have to list every trade, just your total profit or loss, including unrealized gain or loss, on the 31st of December. This is how easy it is. Step 1. List total gains and losses by account. Step 2. Cumulative total gains and losses for all accounts. For example, $150,000 in total losses, $300,000 in total gains. Step 3. Enter your net gain or loss for all accounts. In this example, it would be $150,000. Step 4. 40% of your $150,000 in gains would be $60,000. This $60,000 would be taxed at whatever your applicable short-term tax rate is. Step 5. 60% of your $150,000 gain would be $90,000. This $90,000 would be taxed at whatever your applicable long-term tax rate is. That's it. You're now completely done with your tax reporting requirements for your CME crypto gains. Now let's look at taxation for U.S. residents trading cash or perpetual futures contracts through a company like Coinbase. Since the IRS does not consider companies like Coinbase a qualified futures board or exchange, all trades done through a company like Coinbase, including perpetual futures contracts, do not fall under the 1256 tax rule. All gains on all trades less than 1 year are subject to whatever your applicable short-term rate is. If you're subject to U.S. taxation, when you file your tax return, you're required to use Form 8949. You must list the date, price, amount of every trade or transaction, your entry, your offset, proceeds, transaction costs, adjustments for gains and losses. This applies even to crypto swaps or purchases made with crypto. To me, this seems beyond abusive and an absolute nightmare. And all that are subjected to U.S. taxation are required to do this on every crypto transaction. Being from the BVI, I thought the U.S. 1256 tax rule and the 6781 reporting requirement on CME futures were bad, until I looked at the reporting requirements and the information required on the 8949 for cash and perpetual futures contracts. To me, this just seems beyond abusive. Short of joining me down here in the British Virgin Islands, where we have no personal income tax, no corporate tax, no tax on trusts, and no inheritance tax, for someone subjected to U.S. taxation, CME futures offer the least abusive tax rate on short-term trades, and by far the easiest way of reporting your gains. When it comes to liquidity, clean bid-ask spreads set by the free market, not a company-run dealing desk, brokerage commissions, verifiable and clean order execution, transparent carry cost paid or collected, account balance guarantee plus or minus trading activity, and taxation. For any investor trying to preserve and enhance family wealth, trading CME futures contracts are verifiably superior to the same markets traded in the cash or perpetual futures markets. If you have any questions, contact me. My team may not be able to accommodate your account due to your regulatory jurisdiction and/or financial status, but we can refer you to a capable, fully licensed broker in your regulatory jurisdiction who can.